Modern banking institutions offer a wide variety of services ranging from credit cards to investments. But at the most basic level, banks are known for being traditional vehicles for savings. Individuals and companies can keep their excess cash in a deposit account, and in return, the bank will pay a set amount of interest. Banks have been the prime choice for those who want to preserve their monetary assets. For one, unlike investments which can lose their value completely due to market movements, deposits left in a bank can only increase in nominal value with the compound interest earned. Saving money in a bank also seems like a safer alternative to keeping money in a wallet or a piggy bank. Traditional savings accounts also provide the flexibility of allowing depositors to withdraw their money at any time, well, until they don't. In March, Silicon Valley Bank, then the 16th largest bank in the United States, hit the headlines as frenzied clients attempted to withdraw over 42 billion US dollars. This illustrates what economists call a bank run. When people have doubts about the stability of a bank, they would flock to claim their deposits before money runs out. When enough people do this at the same time, the bank is unable to fulfill all these withdrawal requests, and we have what we call a bank failure. You may be asking, shouldn't banks be able to return the money to their depositors at a moment's notice? Not quite under the fractional reserve banking system we have today. As the name suggests, banks only keep a fraction of the money deposited as reserves, typically around 10%. To make the banking business model work, the rest of the money is either loaned out to other parties or invested in income-generating instruments such as stocks and bonds. The spread between the income generated by the banks from loans and investments and the interest paid to depositors plus other operating costs represents the profit earned by banks. Clearly, a problem arises when investments in stocks and bonds yield losses rather than gains. When these instruments are redeemed by a bank at a loss to service withdrawals, there will simply not be enough funds to cover all the deposits made. The SVB fiasco actually started with the losses it incurred from its bond investments. When depositors heard about these losses, panic ensued, leading to the bank runs. Do depositors have any recourse at all when a bank fails? After all, they were assured that their funds will be kept safe. Following the Great Depression of the 30s, the U.S. Federal Deposit Insurance Corporation was created to provide deposit insurance against bank failures up to a certain cap per account holder per bank. As of today, this cap is at $250,000. In the Philippines, there's a counterpart called PDIC, which offers up to 500,000 pesos in deposit insurance per account holder per bank. One thing that would have been a problem for SVB clients was that most of the deposits exceeded the deposit insurance threshold of $250,000. That would have meant that depositors could only recover a fraction of the remaining amount. Fortunately, the FDIC decided to also service the uninsured deposits to avoid bank runs from spreading to other banks, even if they did not have any legal obligation to do so. Now, how do we face the fact that bank deposits are not 100% safe? First, diversify savings across a number of trusted banks. This is particularly important if your savings exceed the per bank PDIC threshold of 500,000 pesos. Second, keep a reasonable amount of physical cash on hand. This can help hedge against the possibility that bank failures could spread across the financial system. Third, save in your heavenly bank account. As we have learned from Pastor Sumrall's offering thoughts on building a good foundation for the future from 1 Timothy 6:18-19, we do so by doing good, being rich in good works, being generous, and being ready to share. Banks may fail, the economy may fail, but God and His Word, they never fail.